all of these PDRAs that ICT mentions, whether it's a fair value gap, an inversion, an order block, a breaker block, a mitigation block, an NWOG, a new week opening gap, an NDOG, a new day opening gap, all these PDRAs are simply PDRAs, but without a context, without the narrative, it might be extremely hard to know when to apply it and where to apply it. So what we're going to do today, we're going to break down those two things: when, where, and then also have a look at what these PDRAs look like. It is completely up to you what PDRA you use. For me personally, I like to use fair value gaps, inversion fair value gaps, and that's pretty much it. If there is an NWOG or an NDOG sitting in a zone that I think price could retrace, reverse, or react from, then I'll mark that down. But I'm very, flexible with where I'm able to take my trade. I'm very flexible with what PDRA presents to me. I'm not limiting myself to one, but I'm also not, congesting my mind with, I need to know every single thing, how to apply every single thing. That's not necessary. So a lot of people, are concerned with all the new things that might pop up, whether it's in a new mentorship or on Twitter or a new strategy. Once you've found something that works for you, stick to that and then build a model from that. Once you stick to something, you're going to learn that model. You're going to learn those PDRAs a bit more in depth and a bit more personally. So today we're going to go through a few examples, and we're going to start with using the NWOG or the NDOG, and let's talk about it. Now I want to make this nice and simple. For me personally, how I use new week opening gaps or new day opening gaps, I like to look if they're extremely large, right? So if the price is really gappy and the price gaps quite a bit, I like to mark those out. Now I know ICT talks about marking out multiple days worth of NDOGs and NWOGs, and I will only personally look at that if it's an extremely large NWOG or NDOG. So for example here, you can see, right, this was from, the 23rd of July. And if you have a look at price action, both on Tuesday and yesterday, we reacted from some quadrant levels of this new day opening gap. So simply what you do, this is a new day opening gap, you can see, I simply mark out just this space here. That's what I do, right? That is my new day opening gap, and that's from Tuesday, the 23rd of July. What you can do then is you can extend that over to the right-hand side, and you can see if price uses that as some kind of support or resistance. So realistically, with new day opening gaps or new week opening gaps, whether it's from 2 days ago, 1 day ago, 5 weeks ago, doesn't matter. The bigger, in my opinion, the better, because price will draw more towards that, like a fair value gap. You get me? So realistically, you can see, right? Look how price reacts from this zone, right? If we go back to Tuesday's price action, have a little bit of a look at how fine the price signatures are. You can see, right? Look at this. Look at this from Tuesday. Now, I wonder when that is. Look at the time at the bottom here. That is from the silver bullet. So if you want to use a new day opening gap, you can use that principle to phrase a short position here. That's completely fine. But today I'm going to go through time and price, and how you can use other PDRAs or other concepts to still phrase the same idea. So whatever resonates with you, that's what you should use. If it's a new week opening gap, use that. You can have everything on the chart if you want to, but to simplify it, if I just break that down to quadrants, and this is what ICT talks about himself, you can pull a fib from the top to the bottom, and you can break it into quadrants. Do something like this, right? You can get rid of that, 0.25, 0.75. You can see how we react from the 0.75 level, which is great. So for some people here, they would have been using the reaction from the 0.75. But let's talk about other PDRAs now, right? So that's your NDOG, and the NWOG would be used in a similar fashion. Use that as support resistance. The market can draw towards that, it can trade back into it. All PDRAs can be used as support or resistance in that way, or they can be used and treated like an inversion. That's really important to keep in mind. Now, if we just look at the structure here, you can see obviously that's the new day opening gap from the 23rd of July. You can see as well, we also have a sweep of buy side. So for those that trade a sweep of liquidity, a market structure shift, a return to a fair value gap, that might also play out. Let's just have a look on the 1 minute time frame. And again, this is from the 20th of August, only a few days ago. Really, really nice trading day. Let's just see what we have here, right? Let's see what we have here. Now, looking at price action, what has price been doing? And this is something ICT has mentioned in the past many, many times. The more you drive in one direction, the more likely it is that price can have some kind of reversal or retracement. If I was to mark out the silver bullet time frame, guys, and I was to go, for example, mark out the 3 o'clock price action here, and then I'll mark out the 4 o'clock price action here. This is now a trade for the silver bullet traders. Silver bullet traders. For those that trade a rate of liquidity, a market structure shift, and a return to a fair value gap, you could also take advantage of a short position here too. And you might say, well, where could I do that? Let me just put that back on 4 o'clock and we'll talk through this, right? Because this video, the whole purpose of this is to illustrate that once you found that concept, or once you found those concepts that work for you, stick to that and work on that, develop that, build on that. You can see we've got an internal sweep liquidity again at the top here, right? Let me just get rid of this. Make this a little bit more fine. There we go. There's your internal sweep. Where's your market structure shift? For those that trade that, your market structure shift is below this swing low. So we've got a rate of liquidity, a market structure shift, and where's your fair value gap to enter from? It could be right here, right? For example, right there. So if you want to trade like that, you can trade like that too. For other people like myself, I might use a combination of that, a combination of the NWOG or the NDOG, and I might use a combination of the fact that we're in the silver bullet time frame. So there's all these things that you can use, right? The fact that these things are happening during a key time frame is the important part, guys, because a lot of people, they tell you that, oh yeah, this is a new day opening gap, this is a market structure shift. You want these to happen either in a macro, and this is a time thing, in a macro or during a silver bullet. That's when you want these PDRAs, that's when you want these reactions, that's when you want these things, these SMTs to form in a key time frame at a key level. And we'll talk more about that as we go through in this video. So what we see here as well, guys, we also have an inversion. If you look at price action here, we also have this inversion fair value gap that's created because we close below, right? So we've got more than one PD array that we can enter from. There's no right or wrong to enter position. There's just not, right? So looking at price action here, let's see what we do. Now, at this point in time, you might say, well, couldn't you just wait for a retracement back up into this fair value gap? And the answer is yes. Everyone has a different model, right? And as you can see here, there's different ways to phrase a short position. There's different ways to phrase it. You could simply say, okay, I'm looking for a rate of liquidity or a sweep and then a market structure shift. You could also say, okay, I'm looking for price to just react from the new day opening gap and then take the first fair value gap that's formed. You could also say, and these are all correct, these are all correct judgments. You could also say, I'm just looking for a sweep and I'm looking for an inversion fair value gap. These are all valid judgments. All of these are different PD arrays, inversions, NDOGs, fair value gaps, they're all different PD arrays. You could even use an order block to enter from. So it's just to illustrate that, even on social media or in my Discord myself, it's beautiful to see that there's so many different ways to enter a trade, depending on how you like to see the market. And there's no right or wrong. There's no right or wrong, right? And you can see what price action does here. We're in the silver bullet too, right? So some people just trade the silver bullet session. This for them would be a silver bullet setup or a silver bullet trade. And there's so many more opportunities that you could take in this kind of price segment here. And that could be enough. That could be enough. That could be sufficient. I could mark out so many different ways we could trade here. So for example, we can have a look at price action and we can see, right? Price sweeps buy side, we have a market structure shift. When price pulls back up here, I wonder where we pull back up into. I wonder where. Let's grab a fib from this high to this low. And what we're going to do here is just grab out two important parts, 0.618 and 0.786. Interesting. A lot of people, they just want to trade OTE. And look at what we do. Look at the bodies. The wicks do the damage, the bodies tell the story, as ICT's mentioned. Now, I'm sure you can probably spot more PD arrays here. You've got a breaker block. You've got a change in the stage of delivery past these up close candles when we close below. There's all these things that you could enter from, and this is the beauty about ICT. You find something that works for you, and you use that as an entry model. So these PD arrays are used either as an entry model, or you're looking for price to either respect it or disrespect it. Again, a fair value gap is either going to get respected or disrespected. Either a fair value gap or an inversion. A new day opening gap is either going to be respected or disrespected and maybe used as an inverse. Same with a new week opening gap. Same with an order block or becoming a breaker block, whatever it might be. These are the things that you've got to put into perspective because not one thing is better than another. People will be telling you that, oh yeah, a break is better than this and this and this. Of course, the more confluence you have, the more things lining up, the better. But you've got to stick to a model that works for you. That's the most important part about all of this and all the price structure. Watching price come down, we can see we've got this bullish fair value gap, right? Right there. What's that classed as? An inversion. What happens? Price trades through it, back into it once, back into it twice, and then aggressively sells. For some people, that's their entry model. They're waiting for that secondary swing over. They don't trust this sell side imbalance. They want to see more confirmation. Once they get that confirmation, they'll enter short, or they'll wait for that retracement. Other people enter straight off the market structure shift. So there's all these things to consider, and I think this is an important aspect to talk about. What did ICT really mean about time and price? And my viewpoint on that is, again, fair value gaps, order blocks, breaker blocks, volume imbalances, NWOGs, NDOGs, change in the state delivery, mitigation blocks. These are all PDRAs. That's not how the market moves. These are PDRAs to help you judge, where to enter from, where the market could go. The next part is, okay, well, where do you want to enter from? Where do you want to enter from? Where do you want these PDRAs to form? And that's going to be part 2 of this video. Where do you want these PDRAs to form? And we're going to talk about it. Now, the first place that I personally look for any of these PDRAs to form or any reaction to form is very simple, after sweeping liquidity. So if I was going to make some notes here, the first place you're looking for these things to form is after sweeping liquidity. And you can see that here. We've swept liquidity, we're looking for things to form. What are we looking to form? We're looking for fair value gaps to be disrespected, new day opening gaps to be engaged and respected. We're looking for market structure shift, we're looking for order block creation. So we're looking for these things, we're looking for these PDRA reactions after sweeping liquidity. That's the first one, and we've seen that here. The second is going to be this. When returning to optimal trade entry, and this is how I break down my trades. And I'm going to show you an example of this now. So I'm going to break this down, and this might be about a 20-minute video, but I want this to be nice and in-depth and nice and clear too, right? This is what ICT truly meant about time and price. Simplify the process. Now, what do I mean by when returning to OT? Let's take a look at an example. Now, this chart that we see here, this is from yesterday, right? Day before yesterday, 21st of August. And we can talk about the next one, which is when reacting from optimal trade entry. Now, in order to do this, you need to understand dealing ranges and ranges in general. So what I'm going to do is I'm going to draw a range, and I'm going to mark it out from this low, right, to this high. This is the first range, right? That's the first range. We come back down into the range right here. Pull a Fibonacci up from this low to these highs. Pull a Fibonacci. Look at this, right? So where you're looking for these PDRAs to form, if you trade the Asian session, for example, you're looking for these PDRAs to form either after sweeping liquidity or when coming into OTE. And again, if you have both, it's even better. So if you sweep liquidity inside of OTE, it's even better. And ICT recently talked about rejection blocks, and you can see here, this is a rejection block. We sweep the bodies, look at that, we sweep the bodies with these candles, and we just wick. We just wick, wick, wick. Now, more importantly, there's a macro every single hour. Where's the next macro? Where's the next macro? And this should start to put the pieces together. The next macro is here, which is from 11:50 to 12:10. And this is the midnight macro, by the way. Wouldn't you say that this price structure here and this macro started a trend to push price higher? It did. And where did it start that trend? Where did these PDRAs form that reversal or that pivot point? It formed that reversal in optimal trade entry after sweeping the bodies. After sweeping the bodies using a rejection block. So now we've got two things. We've got sweeping liquidity in OTE during a key time frame, and that is time and price. Looking for these things to happen, looking for these PDRA reactions during key time frames from key levels of the chart or after key things have happened. What key things? Sweeping liquidity or optimal trade entry. And these are just two examples. You can see our price projects. Our price projects. Now, we dig back up into this range. So notice that we come up, back down into this range, into OTE, react back up. Now we've got a new dealing range that we can use, and we can simply put this as the new low. This is the low and this is the high. So if I then pull a Fibonacci on that range, if you're looking for shorts, right, from that high to this low, I'll be waiting ideally for price to come up into optimal trade entry. Now again, let's revise that again. What do we say? We need a couple things. We're looking for these PDRAs to form either after sweeping liquidity or in optimal trade entry. This keeps it nice and simple. This keeps it nice and simple. We sweep liquidity, right? We've swept buy side. Are we in OTE? Yes. What else are we in? What else are we in, guys, in terms of time? Let me mark this out at the bottom. 3 o'clock is going to be here with one line. 4 o'clock is going to be here as well. This is time and price. This is time and price. Time, macro. Price, what I've discussed here in terms of either optimal trade entry, sweep and liquidity. And now we look for those PDRAs. We sweep liquidity, we have this one singular bullish fair value gap, and you see what happens to price. You look, we trade below it, trade back into it, and sell off. But why aggressively? Why do we sell off aggressively? Because we've got these two relatively equal lows sitting pretty. Right, so when you're looking at time and price, when you're looking at trying to, merge these concepts together, it's all about having these PD rays in the back of your mind, choosing which PD ray works for you. Here, for example, we've illustrated an inversion fair value gap. We've illustrated how you could use, for example, an end dog and the reaction from the end dog, the 0.75 level, right? I've illustrated how you could use order blocks or fair value gaps if you like to trade the 2022 model. That's completely fine. It's up to you how you phrase the trade. What we're thinking of when we're thinking of price is looking for these PD rays to either be respected or disrespected. And this is a nice little summary. Or disrespected at key levels or zones. What are those key levels or zones? After sweeping liquidity or at optimal trade entry. Time, we're looking for these things to form either during a macro or during silver bullet. Nice and easy. Now, if you're still here in the video, I'm going to add a few more things onto price. If you want me to talk about these things in a further video, let me know. And I'm going to add two more things on, and that's going to be SMT. And I can make a further video. Just let me know in the comments below. SMT, 3 drives. So we're going to leave it there, guys. Hopefully you got something from today's video. Again, I appreciate all the support. And until next time, peace. I'm trying to simplify these concepts, make it nice and easy, pick what you need, leave what you don't, and follow a repeatable process and you will see success. Peace out.